Good day, I am Kenneth Mendez and I will report the topic Chapter 14 Sales Type Lease Lessor. Sales type lease is a finance lease in which the fair market value of the underlying asset is not equal to its cost, thereby resulting in a selling profit or loss. In a sales type lease, the lessor is assumed to actually be selling a product to the lease, which calls for the recognition of a profit or loss on the sale. Lease is a person who rents land or property from a lessor. The lease is also known as the tenant and must uphold specific obligations as defined in the lease agreement and by law. Gross investment is a total amount that the economy spends on a new capital. This is equal to the gross rental for the entire lease term plus the absolute amount of the residual value, whether guaranteed or unguaranteed. Net investment in the lease equals the amount at which the lease receivable is recognized in a state of financial position. This is equal to the present value of the gross rentals plus the present value of the residual value, whether guaranteed or unguaranteed. Unearned interest income is interest that has been collected on a loan by a lending institution but has not been yet counted as income or earnings. This is the difference between the gross investment and net investment in the lease. Sales. The amount is equal to the net investment in the lease or fair value of the assets, whichever is lower. Cost of goods sold is carrying value of goods sold during a particular period. This is the equal of the cost of the asset sold minus the present value of unguaranteed residual value plus initial direct cost paid by the lessor. Gross profit. This is a usual formula for sales minus cost of goods sold. It is the profit a business makes after subtracting all the costs that are related to manufacturing and selling its products or services. Initial direct costs. This amount is expended immediately in a sales type lease as component of cost of goods sold. These are the incremental costs of obtaining a lease that would not have been incurred if the lease had not been obtained. Illustration. Lessor company is a dealer in machinery. On January 1, 2020, a machinery was leased to lease company with the following provisions. Annual rental payable at the end of each year, which is 400,000. Lease term 5 years. Useful life of machinery, which is 5 years. Cost of machinery, which is 1 million. Implicit interest rate, which is 12%, and present value of annuity of 1 for 5 years at 12% is 3.60. And here's the computation. Gross rental 400,000 times 5 by the 5 years of lease term, which is 2 million. And present value of rentals 400,000 times 3.60 equals to 1,440,000. To find the unearned interest income, subtract 2 million to 1,440,000, and it is equals to 560,000. Now, on finding the gross profit on sale, subtract present value of rentals to cost of machinery, which is 1,440,000 minus 1 million, and it is equals to 440,000. Journal entries. On the books of lessor company, the sales type lease is recorded as follows. 1. To record the sale, lease receivable equals to 2 million and the sales is equal to 1,440,000. To find the unearned interest income, subtract 2 million to 1,440,000, and it is equals to 560,000. The gross profit of 440,000 is not separately recorded because it is included already in a sales revenue. To record the cost of goods sold, assuming the perpetual system is used, cost of goods sold equal to 1 million and inventory cost 1 million. Number 3. To record the collection of annual rental, cash is equal to 400,000 and the lease receivable equals to 400,000. To record the interest income for 2020, unearned interest income equals to 172,800 and the interest income equals to 172,800. The present value January 1, 2020 equals to 1,440,000. To find the balance income for 2020, subtract the present value and the interest income, which is 1,440,000 minus the 227,200 is equals to 1,212,800.